What if the biggest financial mistake of your life hasn't happened yet? What if the decade that determines whether you retire with freedom or regret is the decade you're in right now? Why do some people become financially secure after 60 while others spend retirement worrying about every market headline, every unexpected bill, and every dollar they withdraw? And what is it about your 50s that Warren Buffett would likely consider far more important than most investors realize? Most people get this completely backwards. They believe wealth is decided when you're young. They think the game is won in your 20s, accelerated in your 30s, and mostly finished by your 40s. But what if the exact opposite is true? What if your 50s aren't the end of the wealth-building journey? What if they're the decade where the results finally become permanent? Because that's the part nobody talks about. When you're younger, mistakes hurt, but time is on your side. A bad investment at 30 can be recovered from. A market crash at 35 can eventually become a distant memory. A financial setback at 40 is painful, but there's still time to rebuild. Your 50s are different, not because opportunity disappears, because consequences become larger, and that changes everything. Here's what most people never notice. The closer people get to retirement, the more emotional they often become about money. That sounds strange. Shouldn't experience make investors calmer? You would think so, but experience alone doesn't create discipline. Sometimes it creates pressure. For the first time, retirement no longer feels theoretical. It's visible. You can see it approaching. And when people see the finish line, something dangerous happens. They start comparing. They compare their savings to friends, their portfolio to coworkers, their net worth to strangers online. And suddenly, decades of progress no longer feel impressive. They feel inadequate. That's when one of the most expensive mistakes in investing appears: the desire to catch up. Those three words have destroyed more wealth than most market crashes. Catch up. Think about how dangerous that mindset is. A person spends 30 years investing patiently, building steadily, making sensible decisions. Then one day they decide they're behind. Now patience feels too slow, discipline feels outdated, and risk starts looking attractive. A hot stock, a speculative IPO, a trending investment everyone is talking about. The promise is always the same: quick gains, fast results, easy wealth. But here's what most people get wrong. The closer you are to financial freedom, the less you can afford a major mistake. Not more, less. That's why Warren Buffett spent decades focusing on something most investors ignore: avoiding permanent losses. Most people think wealthy investors succeed because they find opportunities. In reality, many succeed because they avoid disasters. That's a completely different way of thinking, and it leads to a question few people ask. What if protecting wealth is actually more important than creating it? We'll come back to that, because another trap is waiting. And this one is much harder to see. Success, not failure. Success. For many people, their highest earning years arrive during their 50s. The career is established, the business is growing, income is stronger than ever. Life feels comfortable. Finally, it seems like all the hard work is paying off. And that's exactly why this period can become dangerous, because higher income creates the illusion of greater security. But income and security are not the same thing. Someone earning a large salary can still be financially vulnerable. Someone with modest income can still be financially free. The difference isn't always what they earn, it's what they keep. Yet many people increase spending right when they should be strengthening their financial foundation. A larger home, a luxury vehicle, more subscriptions, more obligations, more lifestyle inflation. Every expense seems manageable because income is strong. But retirement doesn't care how much you earned. Retirement only cares about what remains. That's a lesson many people learn too late. And there's another threat quietly working in the background while all of this happens: inflation. Most investors underestimate inflation because it moves slowly, almost invisibly, year after year. A little more for healthcare, a little more for insurance, a little more for housing, a little more for daily living. Nothing seems dramatic. Until one day you realize the retirement number that once looked enormous no longer feels enormous at all. That's why Buffett has always emphasized long-term thinking.
Not because the future can be predicted, because the future must be prepared for. And preparation becomes incredibly important during your 50s, because this is the decade where a surprising shift occurs. The goal changes. When you're younger, the goal is often growth. After 50, the goal becomes balance. Growth still matters, but preservation matters too. Freedom matters. Flexibility matters. Peace of mind matters. Most investors don't realize this transition is happening, and that's where they get into trouble. They continue playing the same game, even though the rules have changed. Here's another belief most people get wrong. They think wealth is primarily an income problem, but after a certain point, wealth becomes a behavior problem. Two people can earn nearly identical incomes, invest in similar assets, work similar careers, and still end up with completely different futures. One reaches retirement with confidence, the other reaches retirement with anxiety. Why? Not because one was smarter, because one consistently made better decisions. Patience, discipline, emotional control, the ability to ignore noise. These qualities don't sound exciting, but neither does compound interest, and yet compound interest has created more wealth than excitement ever has. That's something Warren Buffett understood better than almost anyone. People often look at Buffett and focus on the investments, the stocks, the companies, the billions. But the deeper lesson is time. Time is what turned good decisions into extraordinary outcomes. Time is what allowed compounding to work. Time is what rewarded patience. And here's the irony. Many people spend decades waiting for compounding to become powerful. Then they interrupt it right when it's about to do its best work. Imagine planting a tree, watering it for 30 years, protecting it through storms, watching it grow, then cutting it down just before it begins producing the largest harvest. It sounds absurd, yet investors do something similar all the time, especially in their 50s, because they become impatient, or fearful, or greedy, sometimes all three at once. Now, imagine two people entering their 50s with similar savings. The first believes he needs extraordinary returns. He takes larger risks, chases trends, reacts emotionally. The second focuses on avoiding major mistakes. He remains disciplined, thinks long-term, protects what he has already built. 10 years later, the difference isn't small. It's life-changing. One has options. The other has stress. One has freedom. The other has uncertainty. And that's the hidden secret of your 50s. This decade isn't just about money. It's about choices. The choices you'll have later. The freedom you'll have later. The opportunities you'll have later. Every financial decision now carries more weight than it did 20 years ago. Every mistake costs more. Every smart decision matters more. Every year matters more. That's why your 50s decide everything. Not because time has run out, because time has become more valuable. The real lesson isn't to become obsessed with money. It's to become intentional with it. To understand that wealth is ultimately about freedom. Freedom from worry. Freedom from dependence. Freedom to spend your time the way you choose. And the people who arrive at retirement with the greatest freedom are rarely the ones who took the biggest risks. They're usually the ones who stayed disciplined when everyone else became emotional. Because in the end, wealth isn't measured by the size of your portfolio. It's measured by how much control you have over your future. And your 50s may be the last decade where that future is still being written.